Hi, it's Mark Wilkinson, and basically the reason I'm sending you this video email is because there's been some developments that are highly profound for you and your clients, certainly all of those clients that are between the ages of 55 and 60. What I'm referring to here is the strategy that has been used in the past for people who have got unrestricted non-preserved benefits inside their superannuation fund. They got to 55 and they could have taken a pension, but that would be subject to tax at marginal tax rates. They would take a pension, they should say they would take a lump sum if they could, which they potentially might be able to receive tax-free, but their benefits have been preserved and they have not been able to make that election. Well, we've had a private ruling that was released just prior to Christmas. There's probably, you may well have seen a number of newsletters and articles dealing with this. The tax officer's view has now changed, and it is possible for you to prepare documentation and commence the TRIS and elect effectively to have your pension payments taxed as a lump sum, and those pension payments will be applied against the tax-free threshold that applies to the taxable component of lump sums. In other words, you've got the capacity to receive that pension tax-free. Now, this fundamentally means that, in fact, a transition to retirement pension with that strategy is a no-brainer for virtually every client. Having said that, the recommendation to commence a pension is most definitely also financial planning advice, and so you need to be aware of that and the way in which you introduce your clients to the prospects of being able to utilise this. So if we go through and just examine where we've been in the past and where we've finally ended up, the reason this strategy works, particularly with unrestricted non-preserved benefits, is that because you've got the unrestricted non-preserved benefits in there, the trustee or the member has always had the ability to elect to take part of their benefit out as a lump sum. So if you think of an example such as Pete, and Pete is earning income of $180,000. He's 55 years of age. All of his benefits inside his super fund are taxable. If he takes a transition to retirement pension, he will add additional income to his assessable income, and that income will be taxed at the marginal tax rate, which in this case is 45%. He will receive a 15% tax offset, but there is a tax liability associated with that. In the past, I've calculated that, in fact, where that's your scenario, you actually need to earn 8.3% inside the super fund before there is a benefit in the transition to retirement pension. Now it would appear that, in fact, there's going to be a benefit whether the fund derives any assessable income or not. So Pete's got is over 55. He's got $1 million in his fund, and he's got a minimum pension that needs to be paid to him of $40,000. Now, on the top marginal tax rate, less the offset, that's a tax liability of $12,800. If he's got pensions, if he takes that as a lump sum, he applies his $40,000 minimum pension against his lump sum threshold, and then we've got a situation where there's no income tax applicable to that at all. So that's where the benefit arises. The other benefit that you get with the cash out and the recontribution strategy is that you've got the trustee has got the ability to take that payment as a lump sum threshold or lump sum amount, which means that, in fact, it can be paid to him in specie. So where you've got unrestricted non-preserved benefits, it's tax-free if you make the election to receive it as lump sum. It is also can be paid in specie. How does that compare with somebody who doesn't have unrestricted non-preserved benefits? Well, the private ruling now says that they can also be taxed in the same way. So you make the election to have it taxed as a lump sum, and you don't pay any tax. What are the differences, though? First major one is that the amount that is paid, that you've elected to have taxed as a lump sum, is in fact still treated as a pension for the purposes of the maximum pension payment. So you do not want to exceed your 10% threshold. You've got to take that into account. Second thing is that the tax office is taking the view that the trustee or the member notified the trustee that his benefit was to be taxed as a lump sum. He didn't notify them that it was a lump sum. As a result, the benefit cannot be paid in specie. So it's counted towards the 10%, which wouldn't be the case if it was unrestricted, non-preserved. It cannot be paid in specie, which would not be the case if it was unrestricted, non-preserved. So they're the two of your fundamental differences between the existing strategy and what's now available. The third thing I think that we need to take into account is that this is at this stage, an unpublished private binding ruling. The only person that is bound by, the only person that is that the tax office is bound with respect to is that taxpayer that applied for that ruling in the first place. You might remember that we had private binding rulings with regard to zero interest loans too. If you want to protect yourself and utilise this strategy, you will need to apply for a private binding ruling. I can assist you with that. Obviously I can assist you and we'll be able to work something out. We need to move, or I should say you will need to move reasonably quickly. I suspect that there will probably be legislative change. Even before this ruling was released, we were being told that the tax office and the government was considering banning transition to retirement pensions, and we also know that they're looking at the taxation implications of how benefits are going to be taxed. So there's lots of changes taking place, but the opportunity is there. So thanks for watching. And one final thing, for those of you that are not members of my technical support team, this might be an issue that you might need some help with. You might want to consider signing up for that particular service on my website. Thanks very much.